Hi, everybody. Welcome to the last panel of today, deploying capital across stablecoin and on-chain finance infra. I will have these two amazing panelists joining me today, but before that, I'll just briefly introduce myself. I'm Petr Hluze from Nammu Capital. GP there, we focus on early-stage projects across stablecoin infrastructure and projects. Okay, guys, can you just briefly introduce yourself before I frame the panel and we jump into questions?
Of course, happy to. Thank you. Hello, everyone. I'm Selin Suntay. I work as a venture manager at Bpifrance. Bpifrance is the French sovereign fund. They have 72 billion assets under management, and 300 million of it is over blockchain and crypto.
Hi, I'm Daniele Pinna. I'm an investment partner at GnosisVC. We invest across three-stack vertical of involving decentralized infrastructure, real-world asset issuance, and we call it payments middleware, which kind of captures everything between payments rails, on-ramps, off-ramps, heavily focused on emerging markets.
Okay, perfect. And just to frame the panel a little bit in the beginning, I think both of you, but everybody in the room also, is well aware of that last year was quite clear proof that stablecoins and on-chain finance is here to stay. And I mean, we saw 35 trillion in transactions and stablecoins. We saw, I think, over 1 billion into investments into stablecoin projects, regulatory clarity increasing for sure, enterprise is going into the ecosystem as well. So that's clear. What's maybe less clear is where the value is going to accrue, or is accruing at the moment, and when it's going to accrue in the future. And that's something we will try unpack here together. So we'll talk about yield, we talk about stablecoin stack, and about regulatory allocation, and which is influencing everything basically. Okay, so let's start with stat value accrual and stablecoin stack. So for me, because investing also, it's quite clear that for now the value is accrued heavily into still into issuer side, but it's slowly changing. Middleware, orchestration layer, applications, it's capturing more and more. And so my question on you guys, it's where do you deploy capital now? What do you avoid, and is it going to change in the future?
Yeah, I'll go first. So the yield sources, are quite heterogeneous on-chain, although the last year has clearly shown that TradFi yield origination is growing incredibly fast, just purely by virtue of the stablecoin market becoming bigger and bigger and bigger. To answer your question, where should the money be deployed? It should be, who can capture that flow? Because even though the yield is being generated off-chain, I would argue in the real world where humans live, where the economy lives, and where credit lines are originated in partnerships and business dealings. However, the distribution of this yield does get on-chain, where products can be packaged very dynamically and permissionlessly. Obviously, yeah, we can add the whole layer of smart contract risk, but let's ignore that for a second. That's not the scope of this panel. So I would say I would invest in whoever can capture these flows as they trickle on chain and get repackaged. Okay, makes sense.
Yes, Selin.
We are a very specific investor, I would say, being state-owned and public. Our mandate is obviously a big. Yeah. So on the issuance, we've looked a lot internally also. At the time, there were works around us launching our own stable. However, as you know, as a bank, we are regulated by the ECB, and the work has been fortunately taken by the ECB as well. So we have stopped, but still very convinced that this is the path to go. And today, as you say, we see issuers everywhere. In France, however, in the market of issuance per se, the reference today still remains Société Générale Forge, who has been upfront into the issuance landscape, but obviously we haven't invested in Société Générale, it's just a good partner we have. However, I would say that there are different theses that we've taken, but it hasn't been only focused on, infrastructure or orchestration. Of course, it has been covered, but we have had investment from ledger, so very B2C hardware, to async, Lightning Bitcoin. I mean, we have had different type of investment, and it has been in the infrastructure, orchestration, and all the other layers as well.
Okay, what about the application layer? Is it something you looking at or not yet?
Today we are obviously looking at the solution that already, I would say, embed stablecoin in their own infrastructure. That's for sure. There is, I would say, still a maximum exposure into what is infrastructure, mostly because also it's linked to the fact that on the ground we have a lot of tech schools that are like showing a lot of great tech talent as well. So infra has been a forte in France for long, and it has been reflected on our portfolio as well.
Okay, clear. And just maybe a quick question on your mandate, because I know that it's influenced by the bank origins, and also that the fact it's French, like sovereign fund. So, can you invest outside of Europe as well, or just within Europe, or it needs to be some element of French founder?
Yeah. So. Being state-owned, obviously, we have a mandate to support first France. That means that every startups that comes to us has to have a link to France, whether the founder nationalities, whether it's center of activities, biggest clients, like it has to have a certain substance, I would say, in France, but this is given to interpretation. Obviously, it's a case-by-case kind of analysis.
Sometimes it can be more loose.
Of course,
very lucrative.
Yeah, and we are a VC, but we are also LP, and on our LP side, we have no borders, I would say. It's mostly on the VC side, and when investing in startup, this thesis around France is obviously more pushed. Yeah.
Okay, clear. So, of course, that this value capture, like not just crypto and Web3 projects notice, or players notice, and we see massive investments from TradFi and fintechs. Last year, Stripe, this year, MasterCard buying BVNK, and Revolut making a lot of waves as well, and everybody's like flowing capital into it. So my question to Danielle is, also to Selin later, is in your portfolio, are you noticing, or are you a bit afraid of this competitive play? The fintechs maybe taking part of the pie of your investments?
Yeah. So I mean, I don't want to speak for all the partners, because we have different opinions on this. But from my opinion here is that it's not that they're eating the space. It's value additive, and the reason why I think so is that, well, I guess we're going to talk later about regulatory loopholes, the Clarity Act, Genius Act, MiCA, and so on and so forth. But aside from putting those aside, the other thing that the on-chain space allows is to aggregate extremely heterogeneous sources of yield, which, again, they don't always exist. They're volatile. They pop up here and there. So it creates a need for a last mile player that, again, captures or integrates the yield flows as they appear on chain through interest rate arbitrage opportunities and other such flows. And so in that respect, I don't see how they remove the last mile player. also they're bigger, so there's an inertia element to how quickly they can move in a quickly evolving space.
Yeah, definitely, especially banks. But fintechs moves a bit faster than banks, but yeah, it's
I don't know.
speed.
I don't know, man. You haven't been able to withdraw crypto assets from Revolut until what? I think this year. So
right.
like, I don't know. I don't know how fast they actually move.
Okay, agreed.
I always been a bit interested in this topic around opposing fintech and crypto. I started in fintech in 2016. I saw Revolut being like this at the time. And then I deep dive into crypto in 2018. And it was for me a subset space of fintech because it was finance and tech. Why should we look at crypto as being something different? Indeed, fintech, cloud-based fintech have started with the first use case that has been payment. Crypto has been trading. But I mean, in the end, it's still fintech. So are fintechs eating the pie? I'm not sure. I think the fintechs that we see today entering the space are mostly using the stack, the infra. I will mention Formance, which is initially a cloud-based settlement solution. And eventually now they have integrated stablecoin just for the infra. They don't do any crypto whatsoever. And I don't think that those players are actually eating the space. I think they leverage the technology for the use case they have, which is the best approach that should be when innovating in finance.
Yeah, okay, good. Yeah, I agree. They're scaling the pie, if anything. They're definitely scaling the pie. Like they're definitely bringing. They're the big players. They're the big monoliths. They're going to bring in the liquidity. And yes, of course, when certain tools that operate on the tech stack, like was just said, become very standardized, of course they're going to be incentivized to introduce them in their nicely polished, user-facing, like B2C framework. But there will always be other stuff being built on top that is going to capture the majority of the value in the last mile, precisely because it's not easy to package in a simple final product. And so, yeah, the space just keeps evolving that way.
Yeah, I agree, and I think that ties back to the stablecoin stack. There are some layers which may be disrupted more. Some it will actually works other way. They will just make the pie much bigger, and there will be distribution coming from those fintechs. So it's kind of different play for different part of the stack, and also different by jurisdictions. Which brings us to other question, which is more because the product or success of the project is not influenced just by product, but also these days more and more by regulation and jurisdiction they operate. So my question is, if it's something you consider when you're investing, where the project is based. For example, let's say you want to invest into neobank, probably you invest more into neobank in LATAM than neobank in the US, right? So that's where I'm trying to get.
Yeah, so to what you just said, absolutely. Like I said, we have a strong focus on emerging markets. Obviously, more than where they're based, also the team. It's obviously very project dependent based on what you're investing in, but like you look at the team a lot. Do they have a distribution strategy on the ground in certain cases? Who else do they have backing them? Do they have support on the ground? Yeah, so it's hard to make a general rule out of this, but absolutely, you definitely look at specific jurisdictions, what's hot, what's not, where are you seeing flows, who can capture remittance flows to, like Southeast Asia, for example, who's capable of really entering that space and grow fast. We definitely want to see traction, some form of traction before we invest. It's not just pie in the sky projects. You don't want to see crazy ARRs, but obviously, because if we invest in a seed and early stage, obviously, but like seeing some form of traction and a well-defined strategy to retain that traction and grow that is very important. And in last mile solutions, it requires an on-the-ground presence. So where you're based, where the team is based, what is the experience the team has is crucial in that case.
Okay. Maybe, yeah, just to add to this, because I think it will nicely contrast with the approach of BPI. So, because you invest into emerging markets, and those are often, the regulation is, there is maybe not in the same stage as the regulation in Europe or US. Depends on the country, but in general, I think Global South is like that. You as a VC, are you like more adventurous in that, meaning like you're gonna go there even if the regulation is not super clear in some countries?
The valuation of the project?
I mean, the regulation of the jurisdiction where the project.
Oh, the regulation. Sorry. The regulation of jurisdiction. Yeah. I mean, obviously, the more clarity there is, the better. Like if it's a project that is in a heavily regulated environment, you have to show something for that. Like how you're planning to tackle this. You should have already got moving on this. You should have a clear idea of what the costs are going to be to comply with the regulations of that jurisdiction. Yeah, absolutely. That's totally part of the equation. You can't ignore it.
Okay, and Selin, I guess you will have maybe more conservative.
So for Bpifrance, obviously we are regulated by the ECB, so investment I mean, we don't invest in company that goes in Virgin Islands or stuff like that. So that's the approach that is being taken, and it's just regulatory requirement actually. This question is interesting in the sense that this industry has always been has started against regulation in general, let's be honest. But more and more we see this industry becoming like fintechs. How fintech started, this regulatory dance between jurisdiction has always existed. We knew at the time that when a cloud-based fintech was going to Malta, they might have a problem with BD. Why? Because they might have some clients that say, I can't sign a contract with you, you are in the gray or blacklist, so it's done. And we have seen some fintechs coming back to Europe because, coming back to other state members because they couldn't do business in Malta. That happened. And that was in fintech based. Today with crypto, at the time, I remember being at a AWS forum and a VC saying, guys, in front of Standard Charters, Santanders, all bankers, and the VC was saying, guys, I can't have a portfolio that is not represented halfly in Virgin British Islands. So I have to go there because this is where the industry is. And you had all these banker eyes being like super wide and thinking, what is that? What is this Wild West? And I think that more and more innovation has been enabled because we have been able to push these boundaries without regulation. But today, the fact that regulation is coming is because we also see this industry being consolidated. And when we are at this stage of consolidation, it's only normal that banks and other financial institutions are going to ask those players to have the same requirement or at least the same standard that they have. So it's not surprising, but I think today we still see, as we've seen in fintech, some jurisdictions that are like, I would say, advantaged by the fact that they have, let's say, a strong regulator, and we know that when you have a stamp from that regulator, your company is supposed to be like a good running business and things like that. That hasn't changed, I think. Yeah,
I'm going to update my answer because, to her, no, we definitely take a lot more risks than that. For us, being in a gray zone, a regulatory gray zone, is a value prop. Because obviously, if you're investing in something that the regulatory framework already considers, you either have like a very strong distribution strategy so we're investing in the distribution strategy, or it's not a seed investment. You're not doing anything particularly new, right? So whereas if you want to invest in something new, you have to take advantage of the gray zones. Obviously, we think of we have regulations in hindsight in our minds. It's like, how is this gray zone very likely to fall into the regulatory process further down the road? And we do think of that. We do think about this and we ask the founders questions about this, see how they think about this. Obviously, when you're dealing in it's hard to call them unregulated markets, but just poorly clarified markets, you can't have certainty on anything, but you have to take your chances. Also, because there's a lot of technical solutions that simply aren't even conceived by regulators, and even though they are really incredible solutions to pretty obvious problems, like really obvious problems, like ZKID, privacy pools. Like you can make them regulation compliant functionally regulation compliant in the sense that there isn't a regulatory framework right now that these things could be made regulatory compliant for. It's more like these technologies are compliant in like respect the spirit of the compliance rule if only the regulators like expanded the regulatory approach to include these technical products. And so in that sense, even though they're in a gray zone, you do consider them because they do have a viable pathway, theoretical pathway to become regulatory compliant, even though regulators are nowhere near to even considering these tools as compliant.
Yeah, we don't need to go that much back, right? Like in the US a year ago, it was basically the similar environment you just described.
Yes, I mean stablecoins are a classic example. I mean stablecoins are like the first example that people kind of see because it was kind of like it was a technical solution that regulators just needed to adopt. But I'm trying to make an even finer distinction because stablecoins were actively being used. So there was economical value flowing through stablecoins before they obtained regulatory clarity. There are technologies that cannot accrue any value whatsoever without regulatory clarity on them, simply because they revolve at the end of the day between some interface between the real world and the blockchain, and you know the real world. If you think of the real world, I like to call it the meat space, like the space of human meat, like skin and bones, right? It has its own. You can think of it its own blockchain with its own, the consensus rules, whether you think of it as the judicial or monopoly of violence, becomes philosophical. But the point is that, like, if you're building a product that lives at the interface of these two chains, like the blockchain and the meat chain, the real space chain, you cannot avoid real world consensus. Real world consensus has to be integrated for the whole flow to work. And so there are a lot of technological solutions that there are solutions looking for regulatory inertia to dissolve.
Yeah, 100%. Basically, any infra touching banks directly will need regulation to succeed on scale, for sure. So we discussed the regulation in general, but maybe let's bring it to one of the most interesting aspects of stablecoin and on-chain finance, which is yield. So we see these yield wars almost, the discussions and regulatory approaches to how to regulate yield. So Genius prohibits yield on issuer level. Clarity Act may prohibit it even more. Basically any passive yield, including lending and maybe even a reward, may be banned in US. MiCA is also not super supportive. So maybe Selin, because I know you were previously in the regulatory space, right? You worked in regulatory space.
Oh yeah, I was a lawyer in banking and finance.
Okay.
Congrats. Yeah, but no. So I think we don't really depart from the general rule that is same activity, same risk, same rules. It's always the same. So the approach is going to be different depending on the country, but in the end, we are always going to look at a financial instrument per analogy. What is this instrument look like? How does it look like? And what is the analogy of this instrument in the TradFi? That is how the regulation today, do regulation since many years. And I think that over yield, on the passive side, indeed, issuance has been clear. On the other side, they will just look at what is the underlying. Is it payment? Is it an investment product? And then define and put the rule that is according to it. And we will need always to look at the underlying of each activity, because it's not asset-based, it's activity-based. And if we look at it from that respect, we can't be really taking risk in a sense, because we will always work per analogy. Let's take an example. if I decide to offer yield that depends on a specific action from a user, I would consider this yield being either a reward, either an investment product. Generally, because it's digital asset, they will say investment product, but I believe that with time, they will even make the nuance, and we will have probably rewards as they are being seen for, I don't know, Starbucks point, let's say. The same analogy will be put at yield that is earned in the same way. That's what, I don't know if it was clear, but.
Okay.
Wait, I I lost track of the question.
The question?
Yes, can you mind repeating it?
Yes, so for Selin, it was more about like the regulatory side of it. For you, it's maybe more about, so first maybe, what do you think about this the regulatory approach of basically banning the any kind of yield?
Okay, so I'll keep playing with playing in the dark gray zone of crypto. Just because someone has to represent that. So. I mean, crypto is obviously in the business of finding loopholes. That's the whole premise of living in a gray regulatory zone, is figuring out what loophole you can get away with. Obviously, the big hot topic right now is the debate on the Clarity Act in the United States. Is it okay for Circle to pay yield to Coinbase that then Coinbase redirects as rewards to its users? The banks don't like it. Like that's the narrative right now, right? As someone, I'm going to speak from like a cypherpunk. Like, it just feels like unnecessary Luddite friction. The technology wants to be free. The yield wants to flow. The yield will find a way to flow. Like, if you cannot define every possible way the yield flows. Like, what if, okay, you say, okay, Circle, you can't give the yield to Coinbase anymore. Okay, so who does this yield belong to? It belongs to Circle, right? They earn. That's the whole point of the issuer. It's like you're earning a yield, right? Am I allowed? Let's say then this yield is. You know, is yield in treasury bills, right? Can I mint more USDC with this yield that I'm making since I own it? Yes, no, yes. Okay, fantastic. Can I deposit it on Aave and lower the borrow interest rates for USDC on Aave and thus activate a whole machinery of interest rate arbitrage players that are going to try to arbitrage that interest rate? So in the end, did I not flow the yield to the ecosystem? Sure. I'm not paying it directly to USDC holders, but I'm paying it to USDC incentivizers, right? Sure, it's not guaranteed, it's not well structured, it's not like the simple, oh, if you hold USDC in your wallet, you get USDC, right? But Coinbase could then say, okay, fine, your USDC gets directed to like lending opportunities in the DeFi space, and in one way or another, like this yield reflows back to these holders in some indirect, convoluted way. You cannot preclude these convoluted ways from being found. The market will find them because the yield wants to flow to the recipient, and so the path of least resistance will be found. You can put obstacles along the way, but the water will keep on flowing, and this will not stop.
If I can add on it, I think that the perspective that we are looking at is mostly, of course, startup and innovation, right? Obviously, the ban is coming from the lobbying of banks, I think. Like, it's not a surprise. It's just about saying, okay, we have been given this mandate of giving credit to people. In order to pay those credits, I need interest. And this new feature that you guys are having, it's actually going to kill my source of revenue to offer credit. So I can acknowledge that the approach should not indeed be killing the new use case that we see in DeFi, and the reason why DeFi has been actually been so much developed today. So I agree on that point. But on the other side, imagine a world where if everyone was coming to sell their assets, and what do you do after that if a dump happens and this is completely private and there is no guarantee indeed? And today the concerns are coming from people that have known systemics issues and systemic risk. I don't say that regulation have been perfect around this, but we've seen already problem happening in '08. And I don't say that blockchain is going to replicate. On the contrary, I believe the technology is going to show transparency and what we need. But also, pushing it too far, I'm also afraid we forget those kind of safeguards we've been working on over the past years.
Yeah, so I mean, okay, I'm not going to argue with someone coming from the banking sector over like the risks of using tools in DeFi. That said, because again, there's the whole argument of smart contract risks, which were completely, it's not a scope for this panel. But that said, I would argue that DeFi has been a lot more stable than centralized players in the last couple of years. I mean, we've seen major implosions in crypto, and we have over-collateralized lending protocols that are still solvent. That they handled 80% market corrections. They've handled major liquidity players completely blowing up from one day to the next. Think FTX. The FTX disaster, $8 billion, poof. It's like the centralized players are the problem. Because they hide the risk effectively. Whereas the whole point of DeFi, if it's built, the principle of building these financial primitives on DeFi is that it makes the risks apparent. You can simulate you can stress test. Everything is transparent and available for you to explore. I would also add that there's a distinction to be made about a lot of the risk. I think the systemic risk is borne by rehypothecation. And specifically under-collateralized rehypothecation. I would argue that is the biggest source of systemic risks, because you have some big market stress, and then suddenly you're stuck in this leveraged credit scenario that is just not unwindable. That's the whole premise of where, in the fiat system, you have the lender of last resort, the central bank, that can step in, you turn on the printer, and you make it go away, right? Obviously, DeFi is all built with the idea that this doesn't exist. It's like how do you build financial primitives with the idea that there isn't a lender of last resort? And yes, of course, this means building things such as over-collateralized credit lines, which implicitly are less capital efficient than under-collateralized credit lines, but they're also more secure, like way more secure. As long as putting, crazy smart contract exploits and insolvencies created that aside, which is a real thing, but again, out of scope for this panel. Like the mechanical principles are legit, and the proof is in the pudding. Aave still exists, FTX does not.
No, I agree. Just like last comment on that, yeah, for me also the regulation feels a bit excessive on this. It feels it's protecting not really the retail, but more like the banks, right?
Absolutely.
100%.
Absolutely.
And
Absolutely.
Yeah, I would love to see the market to decide, right? If the fintechs want to integrate yield from DeFi source, would be great if user can use it or not. So let market decide. Okay, we have 1.5 minutes till the end of the panel. So let's do some rapid question format. So this one I'm curious. 2030, Circle or Tether, who is winning the game? Or somebody else?
Well, I mean, look, I'm going to give you the purest crypto answer, okay?
Sure.
As someone who's been in the space for a while, never fade Palo Arduino. I realize this is not like, this is very much not don't trust, verify, but typically fading Palo Arduino is a losing bet. So I'm going to say Tether 2030. Also, they're like as big, they've got reserves worth of a central bank, so.
They have a head start for sure.
No comment.
No comment, okay. Okay, so the last one, maybe something, what is like the most contrarian position in your portfolio, or if not in portfolio, what is like contrarian view on something in the space?
I mean, so one of the projects we invested in is a wallet for very, 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 very low-end smartphones. So we're talking Android phones, KOS phones, the phones you would find in like a tiny village in remote Africa, or like somewhere deep in India away from a major city, like those low-end phones. I like to think of it as like a contrarian investment, because how much money could people operating with low-end phones possibly put together? But if you put it in the, we see it more as like a thesis bet, like a longer-term thesis bet. First and foremost, for capturing an entire audience, which right now is completely unserved because major wallets just don't run on those phones. They're just big APK files that don't run on those phones. But also because are we dollarizing the world with stablecoins? Are we going to kill? Is this the end of the euro-dollar market? It's possible. Like, the question would be, I guess the contrarian bet is stablecoins are going to kill the euro-dollar market. That would be my contrarian thesis.
Okay, cool.
Since we have a specific mandate, we have obviously invested in project that with a bit of distance, we've seen that we haven't seen the result we've hoped, as I guess every VC. But given our mandate, there is, I would say, no second guess around why we support it. Because even if it's not successful, the idea behind our investment is always dual and also about supporting the innovation and entrepreneurs. So in that respect, we obviously had at the time, some NFT-based company. I mean, we have been invested in most vertical within crypto. So we've seen during the years what sector have been dying and the others. So yeah, I would say what we've seen on trends has been reflected.
That's a wilder portfolio construction than I would think. Okay, thanks. Thank you guys for answering and spending time and going deeper on this topic.
Thank you very much.